Take the money and run. That's the trade alert today. It's Tuesday. This is our Diamond Club membership update. We had a record-breaking return calling the bottom on the recent crash, and we went long this basket of stocks with no covered calls. Today we're taking profits. Let's look at today's trade alert. Sell all stocks except Apple and move to an 85% Apple position. That works out to 400 shares per $100,000 in your portfolio following the Diamond Club. After that, we're going to sell to open one contract per 100 shares of the Apple, June 21st, 2019, 187.50 call option. Then buy to open one contract per 100 shares of the Apple 28th put option. Here's a screenshot of how to put these trades on. So it's the same thing we're doing in our Whale Club and in the SPY program. We're taking a credit with an in-the-money covered call, which gives us short-term downside protection and a potential to generate a profit if the market goes up. So that's important. We're making money in three directions already. Then we're taking a large portion of that profit. In the Whale Club and in the SPY program, it was around half. So if the market went higher and we were assigned, we were taking half of that profit and putting it into a put option to protect us against downside risks. Now in this trade, we're putting a little bit more. If you look at all the math, you're going to see there's about $1.50 profit built into this 187.50 call option that we're selling against our Apple position. And we'll take a look at the chart, and you can see the gamblers, the fools, want to bet big. And they may be right. Who knows? Apple has a lot of room to go higher, and any good news on the trade war front will give Apple a big boost. And we'll take a look at Apple, Microsoft, a few other tech companies. But what's important here is we have protection to the 187.50 level. And we'll look at the option chain so you can see why I picked that strike. But then we're taking a big chunk of that profit and we're investing it in a put option. So we're going for an extra week of duration. So you can see 1 week further into the future, buy to open the June 28th, 2019, 182.50 put option for $1.15. So that's leaving us with about $35 of profit if Apple goes higher per contract, which is not bad. But the reality is we want Apple to go flat or down to generate a larger profit in this scenario. So that's our plan for this week, and will be the plan for the foreseeable future. And let's take a look at some charts. Real quick, I'll just look at, here's the track record. We'll go to the track record so you can see how I've inputted it. And if you want to do the same on your end, you can. A lot of people like to just follow the trade alerts on their computer and watch their account value grow because they don't want to worry about the spreadsheet. And I can understand that, and that's why the product's designed to be just that easy. So if you look at Microsoft, our biggest position previously, it flew right back to the all-time highs. So there's not a lot of room for just getting back to where it was valued just recently. It's already did that move instantly. Apple still has some major concerns due to the US-China trade war. It has a lot of its sales in China, plus it has its whole supply chain is domiciled in China as well. So it hasn't rebounded back to the highs in April and has a long ways it could potentially run up just to get back to its previous valuation. So the call option gamblers are very happy about this, and it looks like a great bet for them. They can buy these call options and potentially double, triple, quadruple their money. Of course, I'm more worried about losing money. And so if we do look at the option chain, we can see there's a huge purchase order to buy Apple at 185. And what's interesting is if you do look at the last 5 years of weekly charts on Apple, there's only a few candlesticks where it dropped more than $10 in a week. So I think there's no guesswork as to why there's such a huge put option contract with about $1.3 billion would flow into that 185 price point if those put options started to go underwater. So that's why I feel safe in the first place selling a 187.50 call option, because I believe right below that there will be a lot of support. But furthermore, we're buying a put option that's a little bit lower. So the put option we've purchased, again, is this 182.50, which is right below that 185 strike price. So the value of that put option can go up tremendously as we get near it. So we can see, if we go to the option chain and I go to the next expiration, you can see there's a lot less option trading thinking that far ahead. So we have a better idea of what will happen in the short term from the more short-term option chains. But that 182.50 would start to move towards the prices up ahead. So $1, right now when I'm shooting this video, it's trading at $1. So because Apple went up a little bit, this put option became cheaper. Don't worry about the exact credit you receive or the exact debit you pay. What's important are the strike prices, because this is where Wall Street has its money, and that's why we've carefully planned these trades just around that. So if that 185 strike price was to be breached, the strike right below it would start to go up tremendously in value. And so we can see the potential price increase in this put option every $2.50 lower that Apple travels. So the first $2.50 lower, this may only rise in value by about 45 cents or 45% gain. The next $2.50, it can go up a little bit more. So you can see that's about more than 45 cents minus the 7. That's about 32 cents it went up with the first strike. Then it jumped about almost 60 cents. Then it's jumping almost 65 cents. And so these are the price points that we can see our put options start to rise to as the value of Apple travels in this direction. So the potential to double, triple, quadruple our put option value becomes very clear as we get below this 185 level. Meanwhile, if Apple does crash, that's going to create an increase in implied volatility. So that means we may not be able to completely protect our asset to the exact strike we've written. But when we buy to close this covered call for a very large profit, it will reduce almost all of the sting up to that level. And the second we roll over the position into a new in-the-money covered call, we're going to make up for that loss and generate the profit. So as the volatility increases, we want to roll over the position and continue the trade. So this is a very, very defensive trade, but we don't lose if the market goes up or flat. So that's what's important here. We have downside protection, but we're still going to be just fine if the market goes up. Now, just to illustrate how powerful this strategy is, assuming you're getting free commissions at Robinhood, which is what we recommend, or cheap commissions at Interactive Brokers, the worst case scenario for this one is the market goes up and we only make $35 on a $19,500 investment, which doesn't seem that exciting. It's a 0.18% return. But what happens if we can do that 52 weeks a year? Well, we generate a 9.8% return if we're completely wrong. But if we're right and the trade war rackets up, Apple takes a hit. Now all of a sudden our covered call income is skyrocketing. The time premium that the option buyers have purchased is eroding with no profit for them. And the put options we're basically getting to purchase for free skyrocket in value. So all of a sudden we could be making more like 1% a week or more. Okay, let's take a look at the track record. Please note that because I sold an in-the-money covered call, we have an unrealized loss on the stock that's not reporting on this return investment. So it's as though we got to take the big credit, but we haven't had to sell the shares for less than they're worth. So the value of this was 14% before we wrote that covered call. And you can see we've added about 3.5% of protection relative to the credit we took in. So we're long 800 shares of Apple. We sold all of our Microsoft, which hit an all-time high. The rest of them, for the most part, didn't hit all-time highs, but they went up considerably. Microsoft shot up huge, and that's the biggest position in our total portfolio in normal circumstances. But this is not normal circumstances, and the bond market is telling us that a recession is ahead and a stock market crash will follow shortly. And so that's why we have to be very careful right now, because it's all relying on this China-US trade war. Will it escalate? Will it be drawn out? Or will it come to an agreement? We really don't know. But my bet right now is that there's a high probability it's going to escalate before a resolution. And if that's the case, this setup doesn't lose if the market goes higher, doesn't lose if the market goes flat. In fact, it makes about 9.5% a year right now with just this kind of boring trade. But if it goes down, we're set up to make much more. So the first step to modify the portfolio settings was to go put the steady income, which relates to Microsoft, to 0, high yield at 85, cash at 15, target banks at 0. And again, if you don't want to do this, just buy 100 shares of Apple for every 25K you want to put into this strategy, and then follow the 2 option trades. So that was that. Here's where I inputted the buy and sells. A minus is for a sell, and a plus is for a buy. Then we head over here, and we have our open call option, which was to sell to open the June 21st, 2019, 187.50 for a credit of $850, 8 contracts because I have 800 shares, credit of $6,800. But again, this is for a strike that's below the current trading price, so that profit's not accurate until we close it out. And now we've added to our other long put option, so we now have 2 put options out there on Apple with different expirations. And this one is the June 28th, 2019, 182.50 put option. We're long, and we have 8 of these contracts. So we gave up most of the profit. There was around $1.50 of profit if the market goes higher that we gave up, about $1.15 of it to buy this put option. So that's our trade alert for today. Time to play it safe. We had a huge week. Don't need to be greedy. Let's take a look at the top news I've collected over the past 12 hours. Hong Kong is rioting. They don't want China to be able to extradite their people without any kind of court ruling on the Hong Kong side. So China is just spreading its wings and trying to colonize, and people not liking it. Some million people hit the streets protesting. Carrie Lam seems to be bought out by the Chinese, or perhaps worried for their life. Trump is warning President Xi, if he doesn't meet him at G20, that the tariffs go up. And there's no confirmation from the Chinese that he will. Stocks are rallying on hopes that a trade deal will happen and that the Fed will lower rates, making money cheap. They think that he's going to lower rates 3 times this year and potentially all the way to 0 at the rate the bond market's trading at such low yields. Big oil producers are freaking out because demand is crashing, so they're trying to cut supplies. Citi warns that a 20% crash in the stock market will happen if tariffs are risen to 25% on the other $300 billion. There's a short position building in the bond market now, betting that people have overpredicted the move, which I would agree with. And we have a tiny position doing that in our whale club, 0.5% of our portfolio. The rest of it's doing the same setup we're doing on Apple. but on Google and Amazon, which have similar setups to Apple. Here's a little chart about the speculators. The fast money brigade are likely betting the market has gotten ahead of itself on the pace of probable rate cuts. Fed funds futures now indicate almost 70 basis points of easing by the end of 2019. Any indication the U.S. economy isn't doing as badly as feared could lead to a rapid reduction in those expectations and a sell-off in treasuries, just what the hedgies are looking for. Like the actions of the Fed itself, their growing bearish bond wager has become very data dependent. Whether it's a move to reassure the market or a small peace offering to the U.S., China's central bank said it's yuan fixing stronger than expected, so they're protecting it against that magic 7 line, which will help them really protect capital from fleeing their country, which is why I'd say they're probably doing that. This is a negative piece of news for the crypto market, but we're still long Bitcoin for all those following it, as well as all the altcoins. We're trying to figure out when to reduce those holdings to just the top cryptocurrencies and then eventually go to cash. But I think as long as the trade war has the potential to escalate, it makes sense to have a 5% total portfolio position in Bitcoin. A little note that Apple's iPhones can be made outside of China if needed. Great basketball game last night. If you watched it, I was shocked. I thought with Durant going out, they were totally screwed, but they pulled it off by 1. Apple has a backup plan. If the trade war gets out of hand, there's enough capacity to make all iPhones bound for the U.S. outside of China if necessary. What else do you need to see? Inverted yield curve. Fed is about to cut rates. Layoffs are ticking up. PMIs are rolling over. Commodities in the trash. Residential investments negative. Auto sales are negative. Capex exports rolling over. Exactly. I love puts near expiration. So much cheap leverage, so much cheap gamma. Well, that made me laugh when I saw that because we've been doing this since last week already. Beyond Meat grinders, short interest stands at 814 million or 5.87 million shares shorted, representing more than 50% of Beyond Meat's float. Bears are down 574 million in mark-to-market losses as the shares keep climbing. Stock borrow fees on existing shorts reached 134% in Monday's session. And this is the new IPO that's just been skyrocketing up. China is bailing out more companies and banks and easing the lending rules. China's foreign ministry didn't confirm a Xi-Trump meeting at G20, saying information would be released once it's available and pledged to resolutely respond and fight to the end if the U.S. wants to escalate trade frictions. China's passenger car sales fell 12% in May, down for the 12th straight month. And again, China's GDP has been plummeting for the last decade. From very high, extremely high, now only at 6%, but coming from places like 30%. So they've got a very tough, hard landing ahead, and this is right as America's putting the pressure on them. This is just showing all the PhD people not predicting the bond market accurately. Bank of Jinzhou, another troubled regional bank, getting bailed out. Chinese stocks staged a strong rally, so that doesn't make sense. You know, it's quite obvious the Chinese are trying to protect all their assets, their currency, and it looks like they're gearing up for battle. So I don't think they're ready to make any resolutions with Trump. And so they're just hoping that there will be some positive news from G20. Iron ore futures surging, so they're predicting China's going to print a bunch of money to put all their people back to work with more infrastructure that they don't need yet. China's rare earth monopoly is diminishing, especially as this starts to become a bargaining chip. The S&P 500's 4.88% return for June is the best start to a month since October 2011, taking the index to just 2% below its all-time peak, Deutsche Bank. And that's why we're taking the money and running and then switching over to a much safer, smarter strategy with the known risk ahead. I am more bearish than most because of the composition of global growth. The U.S. economy was fine, but I don't think it's an island. Lately, it's simply reflected global trends with a lag. Many comparisons have been made to 2016, but I don't see a repeat for that for several reasons, and he shows the emerging markets taking over a larger and larger chunk of the world GDP versus advanced economies. The real question is if the slowdown is driven by a confluence of emerging market weakness, Turkey, Argentina, Brazil, combined with trade frictions and Chinese deleveraging. That's for sure. 2, end of the cycle. Italy's PMI recovery and Germany's services resilience are the most promising indicators I see. And of course, Germany's super tied to China. We will not likely have $1 trillion in QE, $1 trillion in Chinese stimulus, oil recovery from the 20s, successive massive tax cuts in the U.S., accelerated depreciation, and subsequent wealth effect. These dug us out of the soft landing of 2016. With global growth slowing in a synchronized manner, it's going to take heavy lifting to turn things around. Monetary policy is at its limits, and those who could spend will not. Europe is reprimanding Italy, fiscal effects are fading in the US, and China still shows restraint. Here's a look at China protecting its currency. Look at Bitcoin having a little sell-off relative to probably Chinese thinking there's some security in their currency again. And huge push in Shanghai, 2.5% overnight. Look at the stock chart. After a pretty nasty May, finally the rebound. We are also at this point in the cycle globally where growth is just hard to come by. Inventory levels are not low. We are at full employment, so there are no GDP gains from new entrants into the workforce, and key drivers, housing and autos, don't look to be sources of strength. And he's just saying, what? Even with all this crap, if they get the rates below 2, then just some tiny yield growth would do the trick for pulling money to stocks when there's no other options in the bond market. Trump going off about his favorite thing, tariffs, and I think we'll call it a wrap, guys. So we understand the risks. We've had a huge week, putting 4.5% approximately into our portfolio. And now we're playing it safe with Apple. If we go higher, great. If we go flat, great. We crash, probably even better. There's a little window between around where we sold our covered call and between that put option where we could potentially show some short-term weaknesses. But remember, the second we roll over that covered call, we now get to sell a call option at a much higher yield and generate a profit in 2 trades instead of 1. So the probabilities are on our side. Keep a lookout for a trade alert update this evening for our basic program. It's doing the same strategy, and with the weakness in the SPY, that put option is paying off. If we need to cover the covered call, we will, but most likely we won't. And either way, you'll get an update this afternoon. So thanks again for your time. We're also having a customer webinar every Wednesday at 1 Eastern for only our paid members. And then on Thursdays, we're hosting a Q&A for potential customers. So if you're new on a free trial or expired, you want to ask me some questions and chat with our group, Thursday at 1 Eastern. So look for an email from Zoom. That's our new webinar platform. You'll automatically be registered and get the invite from them. So thanks again, and look for a new update this afternoon.